Okay, we're gonna stay. If you're gonna stay in class, please sit down. If you're not, you can leave, but. Okay. So, Fernando. Somebody from the staff. Okay, folks, please sit down. So as with the other two quizzes, as with the other two quizzes, I'll let you know when the quizzes are done. You can come pick them up. Okay, come sit. If you're gonna sit, if you're gonna stay in class, sit down, please. But nothing right now, after the class, maybe? Yeah. Is it about the quiz? Be a half a point if it's just a math.
Okay, because in my first, I was like rushing and added all of them. My numbers
As I go through, it's pure math there, it's half a point. Okay. Okay. So last session I was talking about valuing patents as options, right? So somebody explain to me again what the rationale is. What is it about a patent that makes it an option? Hey, folks, if you want to leave, go ahead and leave the room and you can just have your discussions outside. Class is on right now. Okay? So what is it about a patent that makes it an option? Yuki? It's the fact that you have an exclusive right. Don't forget the word exclusive. Anytime there's an option discussion, the word exclusive has to come into play. Right? And in the case of Biogen, Avanex has a lot of value as an option. But it also has two existing products that produce cash flows. They're licensed. And the point I try to make is when you discount cash flows, the risk you should be looking at in the discount rate should be the risk in the cash flows. So you have guaranteed cash flows. What's the only risk you face? That the people who guaranteed you those cash flows might default. That's why I use the cost of debt of the guarantors. Which brings me to the third and final leg of valuing Biogen. So I have the value of their existing products, I have the value of Avanex as a patent. Let's talk about the value of R&D as a continuing part of the company. So first, what does R&D create? So when you have a department, there are expenses, right? There are costs. In this case, let's assume that those costs were 100 million last year, and you expect them to grow 20% a year for the next 10 years. So that's a bad sign. That's how much you're going to spend. That R&D you hope and pray will create value. What does that mean? That whatever you spend, you get back plus more. Remember we talked about return on capital and cost of capital? If your R&D earns exactly its cost of capital, every dollar you spend on R&D, you get back $1, there'll be no value created. In this case, I'm going to assume that Biogen creates about $1.25 in value for every dollar it invests. That works out to about a 3% excess return you're earning over the cost of capital. That's what they've done historically. So I'm going to assume that they can continue to earn that 3% excess return. At the end of 10 years, what happens? R&D becomes a neutral business. You earn your cost of capital. So to value R&D, here's what I'm going to do. I'm going to first project out the R&D expense each year. So that's the cost. I'm going to multiply the cost by $1.25. That gives me my expected value. I have no idea whether I will deliver it, but that's my expected value. The difference between those two is the value created by R&D on an expected basis each year. Am I uncertain about it? Boy, am I uncertain about it. So I use a much higher discount rate for this of 15% to discount those excess value back. You take the present value of that excess value created, come up with $318 million. I've got all three slices of Biogen ready to go. My existing business, existing two products, the cash flows I get from it, worth 397 million. Avanex as an option is worth 907 million. R&D continuing is worth 318 million. So if I assume R&D earns its cost of capital, its effect completely goes away. I can just focus on what are your existing products, what patents do you have? You add those three numbers up, you get the equivalent of what you get in your discount free cash flow of the firm at the cost of capital in a traditional DCF. There you try to bring in the Avanex effect into expected growth. Here I'm bringing it in separately. What I'm trying to say is don't double count. If you value Biogen with a high growth rate, and the argument for the high growth rate is it has Avanex, it's going to develop it. You can't add the value of Avanex on top of that because that will be double counting. So let's bring it all together. Remember those three questions I said we need to ask about any real option? Is there an option embedded in patents? Absolutely. The underlying asset is the drug that or product that comes out of the patent. The contingency is you will develop it only if the present value of the cash flows exceed the cost. And there is a life to the option. So it clearly meets an option requirement. Is there exclusivity? What's the answer to that? Yes and maybe. Why yes and maybe? Yes, because you get protection against competition from somebody else producing exactly the same product, but it doesn't give you protection from other companies producing their own drugs to treat MS. So if you live in an intensely competitive market, your exclusivity can very quickly start to fade away. Can I use an option pricing model? I'm really stretching, right? What do you need for an option pricing model? You need to be able to trade the underlying asset, trade the option, do replication. There is zero chance of me trading the underlying asset here. It's a drug emerging from a patent. There's zero chance of me trading the patent. It's not a tradable instrument. I'm pushing the limits of option pricing models when I plug it into the Black-Scholes, come up with the value. It doesn't stop me from coming up the value. But if you push me and say, would you be willing to pay $907 million for Avanex as a patent? I'm probably going to pull back and say, I'll give you 650, maybe 700. But I'm not comfortable fully monetizing it because option pricing models require replication arbitrage. Any questions on patents as options? So the option to delay, something non-viable becomes viable, you develop it, you make money. It could, of course, never become viable, in which case you lose what you paid to get the patent. Let's take a second example of an option to delay. You have an oil company. Your oil company has developed reserves. It produces oil, sells it, gets cash flows, you discount the cash flows. Traditional asset, right? But it has undeveloped assets, reserves. It can choose to develop them or choose not to. It has the right to develop those reserves. And what drives whether they do or not? What's the factor that will determine whether they develop those reserves? But the oil prices go up or not. If oil prices stay at 25, you're just going to sit on those reserves. It's driven almost entirely by the oil price. You could argue that undeveloped reserves for any natural resource company are options. And in fact, if you ask me to draw the payoff diagram, here's what it's going to look like. The cost of developing the reserve is going to become the equivalent of the strike price. You will do it only if the value of the oil under the ground exceeds that cost. And if that never happens, what do you lose? How do you get those reserves in the first place? You either did exploration or you bid at auctions for them. Whatever you paid for it is now gone. That's a call option. So if you force me to value an undeveloped reserves as a call option, and I'm going to put the numbers, I want you to compare whether this is more or less difficult than valuing a patent. First step, I need to estimate the value of the oil under the ground if I develop today. First, how do oil companies know how much oil is under the ground? They're like geologists, they hire, they tap the ground and they come back and say 80 million barrels. I have no idea whether they, but it turns out that their track record is better than equity research analysts. So we shouldn't laugh at them, but they come back and they say there's so much oil under the ground. And then to convert the barrels of oil into cash flows, I multiply by an oil price. And again, I'm not playing oil price forecaster, but I can take the forward prices of oil, compute the expected cash flows, take the present value. That's going to become the S in the model. Get traditional DCF. What's the exercise price? The cost of actually developing the reserve. What is that cost going to be? Well, it depends on what part of the world you're getting the oil out of the ground from. If it's in Saudi Arabia, the cost might be minimal because the oil is 6 inches under the ground. If it's in Canada, it could be immense because it might be 5,000 feet under the ground and frozen in ice. But most oil companies know, depending on the part of the world, what to cost to actually develop the reserve. That becomes the strike price. And here's where this option is going to get easier than the pattern. The pattern, remember when I talked about variance and value, we had to do this little dance of let's run simulations and estimate. What's the thing that's driving the variance here? Oil prices, right? I don't have to do any simulations. This is a traded instrument. I can look at the variance in oil prices. That becomes the variance I use in the model. So I've got S, I've got K, I've got sigma. My risk-free rate kind of falls out of whatever life I attach to the option. But what's the life of this option? How long do I get a reserve for? So I get the rights to develop a reserve. Is it in perpetuity? Used to be at one point in time, oil companies would get a reserve and they said, now you actually bid at an auction. So the US government might open Arctic reserves for exploration. You bid, you get it right for 20 years, 25 years, at the end of which it reverts back to the government. That becomes the life of the option. But remember we said with real options, we need something that forces exercise. Otherwise, everybody will just sit on the reserves. There has to be a cost of delay. Once this reserve becomes viable, something to trigger you to develop. In other words, there's going to be a cost once the reserve becomes viable. I've said, this is what I lose by waiting an extra year. Because part of you is always going to wait, right? Oil prices could go up even further. The cash flows you get from developing the reserve on an annual basis become the equivalent of that cost of delay. It's a dividend yield in that Black-Scholes model. That becomes the trigger. There's one final component to natural resource options that has to be brought into play. So let's say you work at ExxonMobil, oil prices go to $150 a barrel. You decide to develop a big chunk of your reserves. So you pick up the phone, that's the way you do it. Maybe you have a more updated way of doing it. Call it, get those reserves going. You get oil out of the ground the next day. Takes a while, right? There's a development lag between the time you decide and will that reduce or increase the value of these reserves as options that you have to wait a couple of years before oil comes out of the ground? Dean? And tell me why. One is a pure present value. The other is there's this, why did you choose to develop the reserve? Because oil prices got to 150. If you need to wait for 2 years for the oil to come out of the ground, you're saying maybe oil price will be back to $60 before that happens. On both dimensions, you worry about that's a development lag. So let's apply this on an oil company. Let's see if we can value the undeveloped reserves in an oil company using this approach. The company I'm going to target is a company called Gulf Oil. Major oil company in the 1980s. And I'll tell you why I had to go all the way back to the 1980s to pick a company to value using this approach. It was targeted in a hostile acquisition precisely because it had lots of reserves. How much did it have? 3.038 billion barrels of reserves under the ground. And it was estimated it would cost about $10 per barrel to develop those reserves. In other words, it would be an upfront cost of 30.38 billion if they choose to develop the reserves. It's a lot of money. Oil prices then were $22.38 a barrel. The variable cost was $7. So every barrel of oil they get out of the ground, they make $15.38. So think of 3 billion barrels of oil, you make $15.38. There is a lag. If you decide to develop, it will take about 2 years before the oil actually comes out of the ground. But here's the factor that's going to give the optionality. The oil prices, which are at $22.38 per barrel right now, could change. How much? The variance in oil prices that you can observe by looking at traded oil over the last few years is 0.03, which means the oil price could go higher, it could go lower. That's going to drive the value of the option. If you choose to develop the reserve, the cash flows you will get each year will be about 5% of the value of the oil. So that's what you give up by not developing the reserve. That's going to become the cost to delay. We have all the pieces we need. Let's go through the process of trying to value this reserve as an option. First step, I need to estimate what the value of this reserve is if I decide to develop it today, right? 3,038 million barrels. Now, normally this would require projecting out how many barrels of oil you get every year, take the expected price, take the present value. I'm going to take a shortcut. I'm going to take the 3,038 million barrels, multiply by 1538. That's what I make per barrel. And because I have to wait 2 years, I don't get the first 2 years of cash flows. I'm going to take out the effect of the first 2 years. It looks like discounting, but I'm taking out the first 2 years of cash flow. What I get is the present value of the oil under the ground is 42.38 billion. It'll cost me 30.38 billion to develop these reserves. If I stop right there and ask you for a DCF value for these reserves, all you need to do is subtract the 30.38 from the 42.38. That gives you a $12 billion intrinsic value or a DCF value for the reserves. And that's where we would stop prior to the real options argument. But remember, they haven't developed the reserve yet. They have 12 more years to do it. Of course, each year they wait, they give up the cash flows of 5%, so that becomes a cost to delay. And oil prices could move 0.03. If you plug those numbers in and using the option pricing model, you get something magical. The value that you get for these reserves, valued as options, is $13.3 billion. So I want to pause right there. This seems almost magical. I took a DCF value of 12 billion for the reserves. Is everybody clear where I got the 12 billion? It's just the 42.38 minus the 30.38. That was my DCF value. I'm now arguing that these reserves are worth 13.3 billion. Where's the extra $1.3 billion in value coming from in the option pricing model? Where's the extra 1.3 billion? Go ahead, Dave. It's coming from the fact that not even the probability increase, that oil prices are volatile, right? If I made the variance of oil prices 0, what will happen to the value of this reserve as an option? It'll go to 12 billion. You basically go to my DCF value. If I made the variance 0.06, I doubled it, it'll increase the value of the option from 1.3 billion to 2.5 billion. You see what the implication of this is, right? When we think about valuing oil companies, we know the level of oil prices matters. Higher prices translate to higher value. What option pricing models tell you, it's not just the level of oil price that matters, but how volatile those prices are. Here's your best case scenario for value for an oil company. You want oil prices to be high and volatile. What's your worst case scenario? Low and boring. What happened in the 1980s and 90s? Oil prices went to 25 and hardly moved. Wondered why there was even a market. It's always $25 a barrel. Worst case scenario for oil. So when you think about oil companies, think about them as a mix of traditional DCF, the oil they're producing, and the option of undeveloped reserves. And that proportion varies across oil companies. An Exxon Mobil or a Royal Dutch gets 85% of its value from the former, 15% from the latter. A Petrobras gets about 30% of its value from the first and 70% from the latter. So more of Petrobras's value is driven by the optionality because more of its reserves are undeveloped. Any questions? Yes. That's a good, it's a quite, what I'm also not factoring in is there's an inflation factor that will affect the prices. So I'm kind of hoping they kind of offset. That's why I said to do this right, what I have to do is take the 3.038 billion barrels, produce based on capacity, say 150 million barrels every year for the next 20 years, get an expected oil price, discount back at cost of capital. I've kind of cut through all those steps because that would be the way I would get the S in the model in the first place. So now let's bring them both together into valuing Gulf oil. You have developed reserves and undeveloped reserves. So we value the undeveloped reserves at 13.3 billion. So what about the developed reserves? Those are not options. They're developed oil going to come out of the ground. I take the present value of the cash flow, 915 million every year for the next 10 years. So what happens after year 10? There's nothing left. Once the reserves are gone, there's no terminal value, no salvage value. present value of $915 million every year for the next 10 years, at a 12.5% cost of capital gives me a value of 5.07 billion. You add the two numbers up, you got the value of an oil company. Would I do this for a Royal Dutch? Not really. It doesn't make sense. But if you gave me a small oil company that's getting the bulk of its value from undeveloped reserves, or a small gold mining company, or any kind of natural resource company, you're going to see this play out. So let's put on natural resource companies, let's pass it through the test. Is there an option in undeveloped reserves? Yeah, right? There's oil under the ground. What's a contingency? The value of the oil exceeds the cost of developing, you develop. Okay, that was easy. Is there exclusivity? Or if there is exclusivity, where is it coming from for an oil company? Isha, where's the exclusivity coming from? That and the fact there's only so much oil under the ground, right? So it's a natural resource. That exclusivity is going to give it value. But as with pharmaceuticals, what do we use oil for? We don't drink it. I don't think so. We use it for energy, and to the degree that alternative energy sources can provide that energy, the optionality is going to start to get. We're seeing that fossil fuels are actually a lot more resilient than we thought they were, right? They're not going away anywhere. They still seem to hold their own, but that's what you worry about. Can we apply an option pricing model? This is about as close to being able to do it as we're going to get, right? What is the underlying asset? The oil under the ground. Can you trade oil? Absolutely. Can you trade reserves? Oil companies do it all the time. They buy and sell reserves. You can actually do replication arbitrage with real options. And that's why real options have their deepest roots in natural resource companies. Oil companies have been using them for 30, 35, 40 years to decide how much value to attach to reserves. That's why oil companies don't give away non-viable reserves, saying, we don't need them, you can take them. They treat them as options. They're options. Even non-viable reserves have value because oil prices have fallen. In fact, staying on that theme of scarcity driving exclusivity. Now, let's say you buy a building in New York City, 4-story building, East Village, you know what price you pay for it. There's a value for the building, right? You can value it based on rental income and come up with a value. Every New York City building, that value is going to have an option premium on it. Why? Because land in Manhattan is scarce. Why? Because it's an island. Don't do this in Kansas City. It's not going to end well for you because all they're going to do is keep building out in every direction. There's nothing to stop you. If you ever flown into Vegas, you know exactly what happens, right? It just sprawls out. LA the same way. But Manhattan has this advantage of on one side you have the Hudson River, the other side you have, the East River, and basically you're stuck with the land. And in Manhattan, there's one other thing that drives the optionality. Every square foot of Manhattan has been spoken for. It's been spoken for in what sense? There are regulations on what you can build on that land, how much square footage you can build. So if you have a building of less than that maximum square footage, you could argue that you have the optionality to increase the size of the building. Would you do it? Maybe not now, but you could. There's an option value. In contrast, if you have another building that's already at full capacity, there's going to be much less optionality in that building. So something in real estate that you don't think about as an option, but does come into play when people decide how much to pay. So now let's talk about a second kind of option, the option to expand. And this is where things can get really hairy because you're now starting to break rules in finance that you're not supposed to break. I come to you with a project, and I'm open about the fact that it's a negative net present value. It's a bad project. But I say, you know what? Wait, before you reject the project, I have to tell you that if you take this project, even though it is a negative net present value, it gives you the rights to a second project. That second project, let's call it the project to expand. And you ask me, well, how good is that project? Right now it looks bad. So basically you've got a bad project that gives you a right to another really bad project. Saying, why would I do it? Because the second project is an option. It's an option where you can choose to expand or not expand. And if you think about what you're looking at here, it's the underlying project. The present value of the cash flows in that project become the equivalent of the underlying asset. The investment you need to make to expand becomes the equivalent of the strike price. You will expand only if the present value of the cash flows exceeds that investment. And if not, what do you lose? What is this price you pay for this option? You took the first project, right? Which had a negative net present value. That becomes the cost of the option. I know it sounds incredibly abstract, but here's a very simple way to see why it can make a big difference in your DCF valuation. I'm going to take an example here. It's a completely made up example, but I'll use it to draw some implications for why investors need to care. I come to you with a virus software company. Yeah? Got a history, it's got margins, revenue growth, you plug in the numbers, growth, margins, reinvestment, free cash flow, you discount the cash flow, you come up with 115 million as your DCF value. You're done, right? Say, but wait, this antivirus company, as it's selling its product, is also collecting data from its customers. That data can be used to create potentially a database business in the future. How long in the future? Anytime over the next 5 years. So you ask me, well, how lucrative is that business? I'll tell you, and you're not going to like it. It'll cost you about $500 million to get into that business today. And the cash flows you can get are about 40 million in after-tax terms every year for 10 years. You don't even need to do any present value to know that this looks like a bad investment, right? $500 million upfront, you get 40 million for 10 years. Even before discounting, it's negative value. But if you discount at 12%, it's going to get even worse. You're saying, why would I even think about this database business? You have 5 years to make this choice of whether to expand. The standard deviation in database businesses is 50%. It's a very, very, very volatile business. And that's what's going to drive the value of the option. The risk-free rate is 3%. So I plug the numbers in. As I said, the numbers don't look pretty. The present value, 40 million for 10 years at 12% is 226 million. It costs you $500 million to enter the business. What's the net present value? Minus 279 million, right? 5 years, 50% standard deviation. It's magical. The option to enter a business where the cost is 2.5 times what you can make as value is $56 million. So if you're paying for this business, you'd pay 115 million plus the 56 million, and 56 million is coming from that optionality. Sounds incredibly abstract, but I'll tell you an example of how this plays out in practice. Remember when Facebook got hit with the Cambridge Analytica scandal? It made their stock price drop 2017. This was a soaring company. A company had never seen a real downturn since 3 months into its IPO. It only seen up, and it dropped. It dropped to, I think, $133 per share. I valued at that time, the blog post is somewhere out there, you can check it out. I came up with a value of $135 per share. Fairly undervalued, right? Now, what's the rule in investing? You need a margin of safety to invest. And riskier companies, you need an even bigger margin of safety because they're riskier. I'm going to contest that notion. I bought Facebook at 133 and the pushback, God, are you crazy? You just found it 1% undervalued. It's a risky company. And I said, I'm glad it's a risky company. And here's why. I valued Facebook as an online advertising company. So all of my revenues, my total market was the online advertising market. The cash flows are online advertising cash flows. And the $135 is the value of Facebook as an online advertising company. What's on its platform? 3 billion users, right? Right now, all you're selling them is online advertising. You haven't figured out what to do next, or you don't want to do it right now. But there's clearly optionality. Retail products, entertainment, news, whatever. I'm not going to try to value it as an option, too messy, too many inputs to get. But essentially, it means the 135 I get is a bare bones, absolute flow value that's going to be on top of the 135. In investing, people talk about right skew, basically this possibility of huge payoffs. That's what it shows up with Facebook. There's a chance, it's a small chance that you could get these huge payoffs. I'm willing to buy Facebook when it's 2% undervalued. In contrast, Coca-Cola needs to be 10 or 15% undervalued. And here's why. There's no optionality in Coca-Cola. What are they going to come up with? I don't want to think about it, but a drink that makes you thinner as you drink more and more of it, maybe they will. But there is really not much optionality in companies where the product base is kind of, and this is what makes platform companies interesting. Because let's face it, the smaller platform companies, Zoom, Peloton, Uber, Lyft have all had a really tough 18 months. You could argue that you're now getting these companies at their core business value or perhaps a little more. So you might even be paying a little more than their core business value. But these are still immense platforms. There are 123 million people on the Uber platform. You could argue that maybe if they can find a way, you're saying that's stretching. Of course it's stretching. That's what optionality is all about. That maybe there are 120. So this is at the core of why people like platform companies. But what's the key question you got to ask? As you collect data about people, is it exclusive? I'm not sure what what data Uber collects on me, but it's not as exclusive as the data Facebook collects on its users. I don't know what user data Peloton keeps on its subscribers, but my guess is they know a great deal about your exercise habits, more than you probably want them to know. So while you go around telling people, I exercise 40 minutes a day, Peloton saying, no, you don't. You were standing on that treadmill this morning for 27 minutes reading something, I can tell right here. Okay? But there is a degree, so the more exclusive the data they collect on the people on the platform, the more option value there is to that platform. So as you look at this argument so essentially you can see it's a dangerous argument, right? Because I'm asking you to buy something and pay a premium for something that might happen in the future. So focus in then on when the option has the most value. It has the most value when you and only you can do this. That's exclusivity. It has very little value when everybody can do it. I remember when Lime and Bike, the Lime bikes came out, remember you could rent the bike and ride them all over town and then dump them wherever you wanted. The argument that was made by one of the VCs is platform argument. They didn't use the word option, but they said we have a platform, which effectively means we'll think of something to do with all this data we're collecting. The only promise, the only data that a Lime collects on you is where you got on the bike and where you got off the bike. It's location information. And location information, I mean, I remember when this came out, I pulled out my iPhone and I tracked how many apps knew where I was. The apps knew more about where I was than I myself knew. So if I wanted, where am I look at the app, say, okay, you're here. Okay, I get it now. This is not exclusive information of all the information you're collecting. So not all platforms have equal value, but some have a significant amount of value because of that exclusivity. So is there an option? Yes. The option is built around that second project to expand. Is there exclusivity? Here it's all over the place, right? You've got to look at each option to expand separately, and it might be huge in some cases where you're the only player in town and much, much smaller in other cases. And here again, we're stretching with an option pricing model. The reason I try to value the option at Facebook is I could make up numbers, put an S and a K, but nothing is replicable here. I can't trade the underlying asset. I can trade the option. It's kind of an exercise in futurity. So all I can say, it's large as a number, but I don't know how big. And that's why I would not do this as a justification if I'm buying Facebook at twice my estimated value. Then I'm asking for trouble. But to the extent that I'm getting it close to estimated value, anything that happens in the option is icing on the cake. So take a look at your DCF. Some of you have DCFs that are very close to the price, and you're wondering, is that difference? In fact, a few of you have emailed me saying, is that gap large enough that I can buy? To which my response is, still your choice. I can't tell you. You have to decide. But one thing that might break the tie there is if you're looking at a company like Facebook, you might argue that if it's close to value, that it's effectively a buy because you got that extra option on top or whatever you're doing. Any questions on the option to expand? Talk about the option to abandon. The option to abandon is the only real option that's a put option. And here's how it works. You make an investment, it's in a long-term project, and the investment doesn't look like it's working. It's nice to be able to walk away, abandon the investment and get back, let's say you can get back only half your original investment. You're going to regret what you did, but I've given you a floor on how much you can lose. So what you get when you abandon becomes a strike price, and you will abandon when the present value of the cash flows becomes smaller than that strike price. Let's use an example to illustrate. Let's suppose you work at Airbus and I work at Lear Aircraft. Airbus, of course, makes commercial aircraft for around the world. It competes with Boeing. Lear produces corporate jets. Let's say I'm interested as Lear in entering the commercial jet market. So I come to you with a joint venture proposal. I say, look, let's start a joint venture. We'll put up 50%. You put up 50%. That 50% will translate into $500 million. As Airbus, you decide to work through the numbers of this joint venture. And based on your estimates, let's say you come up with the present value of the cash flows of 480 million. So you have to invest 500 million, you get back 480 million. That's a net present value of minus 20 million. So you come back to me and say, no, we're not interested. But I really, really, really want you to be a joint venture partner. So I offer you a sweetener. I say, look, if you become a joint venture partner, anytime over the next 5 years, if you change your mind, I will buy your 50% back at 400 million. Less than you paid, but what have I done? I've limited how much you can lose to 100 million. You can't lose more than 100 million. I've given you an option to abandon. How valuable is the option? It depends on how certain or uncertain the cash flows in the project are. If the cash flows in the project are certain, this option is useless. But at the degree that that cash flow can become higher or lower, there is uncertainty. I run a simulation and say the variance in the cash flow from this partnership is 0.16. I'm going to try to value this option to abandon. What's the number I'm going to compare that value to? Your net present value is minus 20 million. I'm giving you this option. I want this option to be worth at least 20 million for you to become a partner. So here's what the numbers look like. The S becomes the 480 million, present value of the cash flows today. The K becomes what you will get if you walk away from this deal, which is 400 million. Is this an in the money option or out of the money option? If it were a call, it would be an in the money, but this is a put, right? You get the right to sell at 400. It's an out of the money option. The 0.16 is the variance in the cash flows. You have 5 years to make your judgment. And remember, it's a finite life project. So every year you wait, you lose 1 year of cash flow. So the project goes from being a 29, 28, 27. So each year it's going to become less, not because of anything to do with the project, but just fewer years of cash flows. I plug the numbers in and I get a value for the put option of 73.23 million. You say, what does that mean? Remember, your net present value is minus 20 million. That's why you are reluctant to become a joint venture partner. I've now offered you an option to abandon, which is worth 73 million. You add the two numbers up. That basically means you're more likely, doesn't guarantee it because I can't force you to become a joint venture partner. You can now see why when joint venture negotiations, one of the sweeteners that gets thrown in to attract people you want into the joint venture is these options to be able to walk away. So in general, though, the option to walk away is what I think about when people use the word flexibility. That you want to be flexible as a company, be able to adapt. So if you take that option to abandon, it actually is part of a larger story of how valuable is it to be flexible. Yes. You know why I didn't give you the option to abandon for 30 years? You know what you'll do as Airbus then, right? Even if it's a good project. What's going to happen to the value of this project as you go year 1, year 2? Remember, as you go to year 7, there's only 23 years. When you get to year 29, how many years of cash flows are there left? 1 more year. So you know what you're going to do? You're going to collect all the cash flows while the project is good. On the 364th day of the 30th year, you're going to show up and say, I never liked this project. I would like my $400 million back. So that's why I had to cut the abandonment option off much earlier than the project ends. Because otherwise you wait till the very last moment, collect $400 million and get the cash flows in the project. So it's deliberate that I've left you the option to abandon only to the early years and not for the life of the project. So
There's a risk of like after 5 years of the project.
you don't care, right? Because in a sense, you get the option for the next 5 years, you get the present value of the cash flow. So if the project starts to look bad, you just essentially abandon at that point in time and leave the other joint venture partners that have to dealing with the failure. That's exactly why you want the option to abandon, is you want to be able to walk away in case you think the project might crash and fail. That's the present value. But let's remember that's based on expected cash flows today. Let's say 1 year in, you're not selling as many commercial aircraft as you did. You revisit that present value, maybe 3.6. That's the variance I'm computing in the cash flows, is things may change in the business. So it means that when you're a company, especially if you're a company that has a lot of long-term projects, some of the things you're taught to do might not be the right things to do. For instance, you're told enter into long-term contracts, lock in your costs, make them more predictable. That's good, right? But it also means you're less flexible. Your labor union comes in and offers you a 30-year contract, you might negotiate, but try to negotiate more flexibility where if things don't work out, you can lay off people because otherwise you're stuck with those employees for the next 30 years. Building in flexibility is really building in optionality. And it's part of a larger discussion you can have about, hey, what's the value of flexibility and how do you build it into process? Incidentally, one of the things that Goldman used to have the reputation for was optionality. What that means is when things went better than expected, they found ways to augment it. And when things were going worse than expected, they always seemed to find a way to weasel out before everybody else discovered. Maybe having one of you as the head of the Secretary of the Treasury might help. But whatever it is, they had that reputation. It's gone now. But there was a point in time when Goldman traded at a premium over other investment banks precisely because they were viewed as more flexible. And I always thought of it as call options on the upside and put options on the downside. That effectively means you become a more valuable company over time. So let's stop that. When we start on Monday, we're going to start with the last part of real options, and then we'll talk about acquisitions and value enhancement. Yeah.
We were given expenses, but we were given positive revenue. Did we still have to subtract it out when calculating like some of the parts? Because I was sitting there questioning it, because usually on the practice business, we gave us an expense. It was
Like the FCFF didn't have a minus sign in front of it? I don't know, didn't it? I didn't, let me see.
Would you like to create like different 25%? Because it's not,
That's what it is, right? Because we need that. So that, doesn't matter what it's from the right? It's one thing is some protected. Right? Because that's what regulatory does, viable tax.
okay.
So unless you can tell me a story about how your net income jumped up 25%, or that's at 25% increase in percent, so the incrementally has to go.
So without change the, and actually change the growth rate. Because like in order to sustain 3% growth rate, the reinvestment will have to be there. So like it's not a assumption development.
But you have the same value that you can say, because then you do that. Much larger.
Yeah, right. So because I don't want to make that assumption, so I keep the original IP.
So how exactly you solve for the price on the point of view? The price above the short term is return equity minus growth about that.
Yeah.
But you can't do it there. So you use the payout ratio, you use a much lower payout ratio than.
I use the same formula, but instead of thinking hourly, I think the growth rate, the require around 3% to like 75% of 3%. So I just made that something like the growth rate will decrease by roughly like 25%. It's like too complicated to do the computation. I just make that something that the growth rate will.
Your price to book actually went down.
No, it went down to 1.25, roughly 1.25. There's also a decrease.
I'll take a look. If it makes sense, include it.
If it doesn't make sense, how much point will I do for?
And what exactly it is. How far, so it's something I don't agree with, but it's conceptually the right path. It's not going to be much better. Thank you very much.